Hey guys, today I want to show you how to understand the interest rate to better understand your money, credit cards, loan and the economy in general. This is very crucial for anyone who wants to understand their personal finance and the economy. Have you ever wondered how interest rates affect your savings, loans, investments and the broader economy? In this video, we'll break down everything you need to know about interest rates, from the basics to more advanced concepts to better manage your personal finance. By the end of this video, you'll have a solid understanding of how interest rates work and how they impact your financial decisions. So, let's get started. What is an interest rate? An interest rate is essentially the cost of borrowing money or the return on investment for savings. It's expressed as a percentage of the principal amount, which is the amount of money borrowed or invested. 1. Simple interest. Simple interest is calculated only on the principal amount. For example, if you borrow $1,000 at a 5% annual interest rate, you'll pay $50 in interest each year. The formula for calculating simple interest is simple interest equals principal times rate times time. Example, if you invest $1,000 at a 5% interest rate for 3 years, the interest would be simple interest equals 1,000 times 0.05 times 3 equals 150. 2. Compound interest. Compound interest, on the other hand, is calculated on the principal amount and also on the accumulated interest of previous periods. This means you earn interest on your interest, which can significantly increase your investment over time. The formula for compound interest is A equals P, 1 plus R, N, NT, where A is the amount of money accumulated after N years, including interest. P is the principal amount, initial investment. R is the annual interest rate, decimal. N is the number of times that interest is compounded per year. T is the number of years the money is invested or borrowed for. Example, if you invest $1,000 at a 5% annual interest rate, compounded annually for 3 years, the interest would be A equals 1,000, 1 plus 0.05, 1. 1 times 3 equals 1,000, 1.05, 3 equals 1,157.63a. So, the compound interest earned would be $157.63. Types of interest rates. Now that we understand the basics, let's talk about different types of interest rates you might encounter. 1. Fixed interest rate. A fixed interest rate remains the same throughout the life of the loan or investment. This provides predictability and stability, as you know exactly how much you'll pay or earn in interest. Example, if you take out a mortgage with a fixed interest rate of 4%, your interest rate will remain at 4% for the entire term of the loan. 2. Variable interest rate. A variable interest rate can change over time, based on an underlying benchmark or index. This means your interest payments or earnings can fluctuate. Example, if you have a credit card with a variable interest rate tied to the prime rate, your interest rate can change as the prime rate changes. 3. Annual percentage rate, APR. APR is a broader measure of the cost of borrowing that includes interest and other fees. It provides a more accurate picture of the true cost of a loan. Example, if a loan has a 5% interest rate and $100 in fees, the APR might be higher than 5% to account for the additional costs. 4. Annual percentage yield, APY. APY reflects the total amount of interest earned on an investment or account in a year, taking into account the effect of compounding interest. This provides a more accurate measure of the potential earnings. Example, if a savings account offers a 5% interest rate compounded monthly, the APY will be slightly higher than 5% because of the compounding effect. How interest rates are determined. Have you ever wondered how interest rates are set? Several factors influence interest rates, including economic conditions, central bank policies, and market demand. 1. Central banks. Central banks, like the Federal Reserve in the United States, Bank of England in the UK, ECB for EU, etc., play a significant role in setting interest rates. They use monetary policy tools to influence the economy by raising or lowering the benchmark interest rates. Example, when the Federal Reserve raises the federal funds rate, borrowing costs increase, which can slow down economic growth and help control inflation. Conversely, lowering the rate can stimulate borrowing and spending, boosting the economy. 2. Inflation. Inflation is another critical factor. When inflation is high, lenders demand higher interest rates to compensate for the decrease in purchasing power of money over time. Example: if inflation is at 3%, a lender might charge a 6% interest rate to ensure they make a real return of 3% after accounting for inflation. 3. Economic conditions. The overall economic environment also affects interest rates. During periods of economic growth, demand for credit increases, leading to higher interest rates. During recessions, central banks often lower interest rates to encourage borrowing and investment. Example: in a booming economy, businesses and consumers are more likely to take out loans for expansion and consumption, driving up interest rates due to increased demand for credit. 4. Credit risk. The credit risk of the borrower also impacts interest rates. Higher-risk borrowers are charged higher interest rates to compensate lenders for the increased risk of default. Example: a borrower with a high credit score might receive a loan at a 4% interest rate, while someone with a lower credit score might be offered the same loan at a 7% interest rate. The impact of interest rates on personal finances. Interest rates have a profound impact on personal finances, influencing everything from mortgages and car loans to credit cards and savings accounts. 1. Mortgages. Interest rates play a crucial role in determining the cost of a mortgage. Even a small change in the interest rate can significantly affect your monthly payments and the total amount of interest paid over the life of the loan. Example: on a $200,000 mortgage, a 1% increase in the interest rate can add hundreds of dollars to your monthly payment and tens of thousands of dollars to the total interest paid. 2. Car loans. Similar to mortgages, the interest rate on a car loan affects your monthly payments and the total cost of the loan. Shop around for the best interest rates to minimize your borrowing costs. Example: a $20,000 car loan at a 3% interest rate will have lower monthly payments and cost less in total interest compared to a loan at 6%. 3. Credit cards. Credit card interest rates, often referred to as APR, can be quite high. Paying off your balance in full each month can help you avoid costly interest charges. Example: if you have a $1,000 balance on a credit card with a 20% APR and only make minimum payments, it can take years to pay off the debt and cost you hundreds in interest. 4. Savings accounts. Interest rates also affect your savings. Higher interest rates mean your savings will grow faster, thanks to the power of compound interest. Example: a savings account with a 2% APY will earn more interest over time compared to an account with a 0.5% APY, especially with regular deposits and compounding interest. The role of interest rates in the economy. Beyond personal finances, interest rates have a significant impact on the broader economy. They influence everything from consumer spending to business investment and overall economic growth. 1. Consumer spending. Lower interest rates reduce the cost of borrowing, encouraging consumers to take out loans for big-ticket items like homes and cars. This increased spending can boost economic growth. Example: when the Federal Reserve lowers interest rates, it becomes cheaper to finance a car or home, leading to increased consumer spending and economic activity. 2. Business investment. Interest rates also affect business investment. Lower rates make it cheaper for businesses to borrow money for expansion, research, and development, leading to increased economic growth. Example: a company might decide to take out a loan to build a new factory or invest in new technology if interest rates are low, leading to job creation and economic growth. 3. Inflation control. Central banks use interest rates as a tool to control inflation. Raising interest rates can help cool down an overheating economy and bring down inflation, while lowering rates can stimulate spending and investment during a downturn. Example: if inflation is rising too quickly, the Federal Reserve might increase interest rates to reduce spending and borrowing, helping to bring inflation under control. 4. Exchange rates. Interest rates can also influence exchange rates. Higher interest rates attract foreign investment, increasing demand for the domestic currency and causing it to appreciate. Example: If the US raises interest rates, it might attract more foreign investors looking for higher returns, increasing the demand for US dollars and strengthening the currency. How to benefit from interest rates. Now that we understand how interest rates work, let's talk about how you can benefit from them in your financial decisions. 1. Shopping for loans. When shopping for loans, compare interest rates from different lenders to find the best deal. Even a small difference in the interest rate can save you a significant amount of money over the life of the loan. Example: if you're taking out a mortgage, get quotes from multiple lenders and negotiate for the best rate. A lower interest rate can save you thousands of dollars in interest. 2. Refinancing. If interest rates have dropped since you took out a loan, consider refinancing to take advantage of lower rates. This can reduce your monthly payments and save you money in interest. Example: if you have a mortgage with a 5% interest rate and current rates have dropped to 3%, refinancing can lower your monthly payments and save you a lot in interest over time. 3. Saving and investing. Look for savings accounts, CDs, or investment accounts with higher interest rates to maximize your returns. Higher interest rates mean your money will grow faster. Example: shop around for high-yield savings accounts or certificates of deposit, CDs, that offer competitive interest rates. This can help you earn more interest on your savings. 4. Paying off high-interest debt. Focus on paying off high-interest debt, like credit cards, as quickly as possible. The interest charges on these debts can add up quickly, making it harder to get out of debt. Example: if you have a credit card with a 20% APR, prioritize paying it off before focusing on lower interest debts or investments. This will save you money in interest and help you become debt-free faster. 5. Using interest rate changes to your advantage. Keep an eye on interest rate trends and adjust your financial strategies accordingly. For example, lock in fixed interest rates when rates are low, or consider adjustable rate loans if rates are expected to decrease. Example: if you expect interest rates to rise, consider locking in a fixed-rate mortgage to secure a lower rate. Conversely, if rates are expected to fall, an adjustable rate mortgage might offer lower initial payments. Common misconceptions about interest rates. Before we wrap up, let's address some common misconceptions about interest rates. 1. Higher interest rates are always bad. Many people think higher interest rates are always bad, but that's not necessarily true. While higher rates mean higher borrowing costs, they also mean higher returns on savings and investments. Example: if you're a saver, higher interest rates can help your savings grow faster. It's all about balancing your financial goals and understanding the impact of interest rates on different aspects of your finances. 2. Low interest rates are always good. Conversely, low interest rates aren't always good. While they reduce borrowing costs, they also mean lower returns on savings and can lead to excessive borrowing and asset bubbles. Example: in a low-interest rate environment, savers might struggle to find decent returns on their savings, and excessive borrowing can lead to financial instability and economic imbalances. 3. Interest rates don't affect me. Some people think interest rates don't affect them if they don't have loans or savings. However, interest rates impact the overall economy, influencing job markets, prices, and investment opportunities. Example: even if you don't have a loan or savings, changes in interest rates can affect your job prospects, the cost of goods and services, and the overall economic environment you live in. Summary and final thoughts. In summary, understanding how interest rates work is crucial for making informed financial decisions. From borrowing to saving to investing, interest rates play a key role in determining the cost and return on money. By understanding the basics of interest rates and keeping an eye on market trends, you can make smarter financial decisions and benefit from changes in interest rates. Thank you for watching. If you found this video helpful, please give it a thumbs up, share it with your friends, and subscribe to our channel for more tips on managing your finances and building wealth. Let us know in the comments and let's start a conversation to improve understanding of interest rate and how it affects you on your financial independence journey. Remember, knowledge is power when it comes to managing your money. Stay informed, stay savvy, and take control of your financial future. Until next time.